are we in a situation where, although these central banks, particularly I'd say the Fed, which has almost sort of like announced that it will down the cross of this 2% inflation target. It's not the only central bank that's actually done that. I mean, that 2% target is familiar across several economies, including the ECB, the European Central Bank, and also even the Bank of England. Are we in a situation whereby essentially what we're hearing indirectly from these central banks is that about that 2% inflation target that we've been harping on about for God knows how many decades? I think maybe now is the time for you to essentially not think of it as so much of a target anymore, more like an aspiration. I mean, it certainly appears that way.
Whether it's an aspiration or not, I think the signal is that you might not get there and you're going to have to tolerate higher inflation. So how do you best position yourself as an investor? You want to own hard assets. You want to own equities. You want to own Bitcoin. You want to own crypto, things that will protect your purchasing power. Because if you're in a regime where inflation's going to run above target and you're going to have to concede that for either a constraint on deficit spending or any sort of thing that you can't control, perhaps maybe, the fact that just you have stickier inflation categories that just are not willing to fall, right? Then you need to position your portfolio accordingly for that. And that's, I think, something that's kind of very topical for what we're going to talk about today.
Hey guys, thank you for joining us for another episode of CFB Talks Digital Assets. We are the home of informed conversation about crypto for institutions building the future of finance. I'm Ken Odeluga, Head of Content, and I'm joined as usual by my colleague, Gabe Selby, who's Head of Research. Hi, Gabe.
Hey, Ken. Great to be here.
Brilliant. And, we need Gabe even more so than we usually do, which is obviously quite a lot for this episode, because this is another special episode of the kind that we normally do every 3 months, which is a Quarterly Attribution Report special edition. We have just had the rebalancing period. We're an index company. We have quarterly rebalancing. We just exited the rebalancing period spanning March to June 2024. That gives us the opportunity to look back into the markets. So Gabe, give me 3 key market drivers behind the recent market performance.
Yeah, well, I would kind of summarize things in kind of a push-pull type dynamic. We have on one hand some positive things, and on the other hand, we have some negative things. And I think that's where we end up with kind of this mixed to sideways consolidation price action that we saw in the past 3 months. So on the positive side, we'd start by the Bitcoin halving that happened in April. And this is something that happens approximately every 4 years. It's programmatic. And what it does is it reduces the issuance of Bitcoin to miners. It halves it, hence the halving. And that's a simple kind of catalyst to understand in the sense that you have this continuous kind of reduction in supply over time. And it's coming at a time when we've seen new investors coming into the space vis-a-vis spot Bitcoin ETFs. So it's very you can see how it's a constructive catalyst. And then another thing that we've also seen that's similar to this is we saw some more spot ETFs launch, and that's something that we here at CFB are privileged to be a part of. We saw spot Bitcoin and Ether ETFs be launched in Hong Kong. And the last thing, which I know is something we're probably going to spend some time talking about, is the surprising decision to approve the spot Ether ETFs that have been filed here in the US. So these are kind of like the positive things. And then on the flip side, on the negative things, we still have these macro headwinds. So what I'm talking about is this persistently higher inflation that's really led a big rebound in interest rates over the past 3 months. And I think that's kind of put this soft landing. It's put this next move by the Federal Reserve into question. So investors, I think, are feeling a little bit more uncertain about the future. And when you combine, I think, the bullish side and the bearish side, you end up with this kind of mixed result.
Absolutely. And, to your point, actually, to that point that you actually just made, Gabe, to add to the confusion, we're getting some intermediate readings, sort of intermediate term readings, which kind of go the opposite of that as well, although they don't necessarily detract from that sort of like conclusion overall. For instance, we don't want to get too overly contemporaneous. We want this to be applicable for listeners and viewers for as long as possible. Bearing in mind we don't do so many of these episodes, but we had the PPI, US PPI, yesterday, I believe it was, from the day of the recording, which was again slightly softer than expected, or softer than feared, I should say. And then, of course, the most recent jobs data in the US, again, the non-farm payrolls, again, judged to be broadly relatively benign, with as well a lower unemployment rate than was expected. So this is not to sort of detract from what you said about troublesome nature of the data that we're getting. I don't think these readings, those specific readings, necessarily remove that picture, but they add to the confusion, certainly. Do you agree, or what's your take on that?
Yeah, I think that at the time of recording, we've gotten more data, and certainly if you look at the attribution report that we run, it's over specific dates, and so everything that's referenced in the report is using data really from that window. And the stuff that you're bringing up, the inflation report, which happened yesterday, and then today we got producer prices, an update on that. With consumer prices coming in below expectation, that's certainly a good thing. It's caused interest rates to come back down. More notably with that report was, I think, the first negative print
Yes.
in some time for super core inflation, which is a measure that it's a core inflation measure which excludes food and energy, but it also excludes shelter. That had a negative print, and so that's something that the Fed is certainly going to be cheering for. And producer prices coming in negative this morning.
Yeah.
And then last week's employment report certainly sent a lot of mixed signals. You have a strong headline figure, around 270,000 jobs created per month, but we, I think, all know that jobs number is probably overstated, and the rise in the unemployment rate to 4%, it's a 0.6% percentage point increase since the low trough, is signaling that there's certainly more slack building in the labor market. But I think overall, what we can do is kind of take a bigger zoom out, and that's what the Fed's going to do. They're not going to look at just one report, one data point, and start making a decision. We had the FOMC meeting yesterday, and just to get that, kind of gives you a time when we're recording this. And Chair Powell, I think, echoed the same sentiment, where he wants to see, I think, more progress towards a sustained inflation goal.
Sure.
So, that's kind of what we're saying right now.
Yeah, I want to correct myself, because you characterized it more accurately than I did about the reading from the jobs report. I mean, I'd say generally benign, although yes, the headline number was higher than expected, and I think the unemployment rate was the one that was a bit lower than expected.
I was just going to say, I think the Fed knows that these are some anomalies in the NFP reports, because there's a household survey, there's an establishment survey. And what we've seen recently is the establishment survey, which is derived from actual, business listing, or businesses reporting their jobs numbers, is diverging significantly from the household survey, which is people reporting the jobs numbers. And that kind of, I think, I think that obviously still very constructive to say that, when you have an establishment survey saying that they did 270,000 jobs is very good.
Yeah.
On the flip side, you have to kind of, I think, have a little more of a sober look at the full picture, because the household survey has been so weak.
Absolutely.
So
absolutely. So what we want to do next is what we normally do in these episodes, is start to get into the meat of the market performance, and we do that through the lens, as I said, of the portfolio indices that CF Benchmarks publishes, and many of which are utilized by our clients. And we start normally, in funnel manner, where we start with the broad end and we sort of like work our way down to the narrow end. And when we say broad, that relates specifically to these broad gauges of market beta, of which we have two main ones: the CF Cryptocurrency UltraCap 5, and of course the CF Broadcap Index. Now, I believe that the leading index in the rebalancing period was the CF Cryptocurrency UltraCap 5 Index, obviously the 5 top coins by market capitalization, with a 9% rise over the specific period, which was close to its November performance, basically. And then, of course, the broader gauge CF Free Float Broadcap Index, and that rose 8%, so pretty much the same. Can you give us a little bit more color on that, Gabe? You've sort of like flagged to me that there was a narrow performance by the CF Broadcap indices. That's a bit of additional a contour that we can actually speak to as well. So tell me a little bit more.
Yeah, it's very similar to what we're seeing in the U.S. large cap space, where I think a lot of folks have been talking about how NVIDIA has been carrying, a lot of the weight.
There's only one stock, isn't there? There's only one stock, maybe two. NVIDIA and Apple. That's it.
yeah, Apple as well now.
Yeah.
So certainly we're seeing kind of the same dynamic play out in our broad cap, which again is the kind of institutional benchmark for liquid investable tokens, and it's the broadest stroke that you could have. And we're seeing a much more concentrated performance attribution if we were to compare that to the previous 2 quarters. So only 9 of the 45 tokens that derive this portfolio index, finished in positive territory. And of those 9, 8 outperformed the headline figure that you said was 8%, approximately 8% for the quarter. So I think this narrow participation, I think, is suggesting that we're seeing more token-specific catalysts and developments that are driving the token performance forward.
Sure. And, you queued that one right up, perfectly, Gabe. Well done. We'll make a picture out of you yet.
Like we've planned this
picture. Speaking of token-specific performances, apparently we live in the age of AI. AI is everywhere. Actually, it's perhaps not as prevalent as the AI, purveyors would want it to be, but it's certainly very, very visible. And potentially that's one of the reasons for why we saw one particular token, near being the sort of like touchstone, the lightning rod of AI focus, it predictably outperformed within the rebalancing period. What can you tell us about, how it, number one, outperformed itself, and how its sort of like weight or its contribution contributed to the broader performance of our markets as well?
Well, it's kind of funny now that we're talking about this. It's another parallel that we're talking about, where NVIDIA is kind of like the standout star of the U.S. large cap space. It's a very much a AI driven demand story, where you have all these institutions trying to buy up their GPUs, and they're all back ordered, and they're growing revenues by some crazy compounding rate year over year, and they keep beating expectations. But in the crypto space, we're seeing another kind of AI narrative permeate through, and that's with the Near token, the Near protocol, where it stood out. It rose almost, I think, 74%, like 73.5% in this past quarter. Completely stood out compared to the rest of the constituents, and that's because of the protocol's strategic focus on creating like a more democratized, decentralized AI type blockchain type protocol. And you even had the founder of Near be a guest speaker on NVIDIA's AI conference that they had over this past 3 months. And
they didn't miss a step.
Yeah, that was the main catalyst for seeing that price move, as you saw him walk on stage and a lot of the investors, traders started bidding up the price. So they're very focused on AI. They're doing a lot of initiatives on empowering these open web builders. They've launched the standard this near.ai research and development lab, and they're hiring a lot of AI engineers for that. So they're very interested in the space, and they're trying to position themselves to be right in the forefront of this trend that you're seeing in markets. And I guess it makes a lot of sense that we're seeing, well, in the traditional markets, we're seeing that kind of permeate through to the digital asset space as well.
Sure. I mean, and thanks for that, Gabe, because I was mindful of the fact that a lot of our listeners are just not as obsessed as some of us are. I'm not probably as obsessed as some of you guys with, these individual protocols, and would maybe never even have heard of a near or their competitors, right? So you've actually explained, the sort of modus operandi or sort of reason for being of near very, very well. But what I want to ask you, just to round that part off, is, related to how I sort of opened this particular section, how much of that is hype, and, or how much of that is just momentum based on, to put it more politely, based on where we are at in the sort of news cycle of AI. We basically came out the gates middle to late of last year, and we've kind of carried on going in terms of consumer interest, and even, if you like, VC interest, right? Because, to the extent that we can actually decide how much of that is froth relative to how much of that is sustainable, real, they're really doing stuff, then we can see how much of a sort of like a detraction from the next quarter's performance that we may see in the event that near doesn't perform as well, which it's quite unlikely to, given that it rose 74% in the previous in the previous quarter.
Well, yeah, I think it's TBD on how much is going to be fundamentally realized and how much is going to be, like you said, perhaps a little frothy. And, I don't know if it's going to be ultimately us, making a call out on that. But all I can say is that, you're seeing so much, I think, positioning on one side of the narrative. And so do I personally expect for there to be some disappointment ahead from the AI investing narrative? Sure. And I think any sort of secular theme has these bumps in the road. But I also still believe that, artificial intelligence, AI, is going to be here with us for the future and just become more and more impactful to our day-to-day lives, right? So I guess we're just gonna have to wait and see.
The sort of the fact that these digital assets are not only existing side by side with traditional markets now, we're seeing some degree of interleaving of themes, and even perhaps in terms of the industrial interleaving as well. Let's talk about how digital assets have performed compared to the traditional markets. Give us some interesting takes on the differential, or if there even is any.
Yeah, well, I think we've covered a lot of it. And, just to kind of recap, they're still demonstrating a lot of, they're still holding their ground. So, our CF UltraCap 5 index, which is kind of the blue chip bellwether index, has all the mega cap tokens, rose 9%. And that was the leader out of the entire portfolio index group. And our broader measure, the free float broad caps, rose by 8%. So I guess despite all these headwinds, despite some of these other macro surprises tripping things up, they're still, I think, gaining a lot of investor confidence and keeping the momentum overall intact in this new bull market.
Yeah. And again, thinking about the same two broad sort of like asset classes, and maybe this time let's think about NASDAQ versus the crypto large caps, and throw in the additional variable, which we've already talked about. Let's talk about it specifically in this instance, of the Federal Reserve and also monetary policy, and also monetary policy in the sense of, actually doing stuff, which they basically haven't.
Yeah.
How have digital assets reacted to this? The uncertainty that we've actually explained, in some detail right up till now. How have they reacted, and how has that been different, if at all, from the sort of like large cap tech sector in equities?
Well, there's many folks that still believe that your digital asset, your crypto exposure is just being derived from either financial conditions, interest rates, or expectations of interest rates or inflation, right? But the truth is that digital assets do have a lot of diversification benefits, and they have a much more variable relationship with monetary policy or shifts to monetary policy if you were to compare that to the NASDAQ. So one slide that we did here, and we can throw the chart up here for the viewers, is we can show that the NASDAQ 100 index has consistently demonstrated a stronger negative correlation to forward-looking policy rate measures. In this case, we're looking at implied policy rate changes. It's a market-based kind of futures approach to studying that correlation. Whereas the CF Broadcap Index's relationship is much more dynamic. And actually, during periods of implied rate cuts or even hikes, you see that the NASDAQ's correlation kind of stays in that strongly negative zone, whereas digital assets has kind of a more oscillating mixture of correlation statistics being funneled through. So in the end, what's kind of contributing to that delinkage? I think it's more idiosyncratic, more industry related type narratives that are providing catalysts for price action. So again, we're seeing broader adoption in the space with these spot Bitcoin Ether ETF approvals. We might even see now that we're making our way halfway through the year that there might be some shot for a landmark legislative bill for the digital asset space here in the U.S., which is the world's largest capital market. So I think that's also boosting investor confidence. And so I think this broader adoption, these potential regulatory milestones down the road are starting to kind of be priced in the wake of the fact that we might have seen some stalling out on the interest rate or the financial condition side.
Yeah, absolutely. And that, again, that leads us to very beautifully to the next section. Although I want to sort of say, because I just can't resist, that I'll be very surprised to see any legislative breakthroughs. I mean, you're in an election year, and it's the election year to end all election years, is it not, guys? So, good luck with breakthrough crypto. I mean, I could be wrong. I hope I'm wrong. Breakthrough crypto legislation. I mean, you're halfway there. You got a couple of bills that are pretty strong on the books, going through the houses or the House. But yeah, I mean, I think the current political environment possibly argues against that. Maybe 2025. Anyway, yes, we live in an Ether Bitcoin world, so we're sticking with large caps. And another thing that you flagged in the Quarterly Attribution Report, Gabe, is the ETH Bitcoin ratio. Now, in terms of news, it's the ETH side of those two dominating large caps that has been obviously in the spotlight in the rebalancing period. What with the Ether, the surprise Ether ETF approvals in the US. Now, I think what you're trying to say here is, Gabe, is that there's been something interesting going on with the Ether Bitcoin ratio, and it has been reacting, as one would expect it to the ETF approvals. Can you sort of give us a few more details on that?
Yeah. So before I dive in, just to give the listeners and the audience a little bit of a catch up on the ETH BTC ratio, it's a ratio that measures essentially the relative value of Ether to Bitcoin. And this is something I think a lot of native crypto people like to chart, they like to study. And I think it's something that as we kind of go into this Bitcoin Ether world that you were saying, is going to become maybe more top of mind even for the non-crypto native folks, but maybe the institutional investors going forward. And we are certainly seeing a lot of, I think, interesting swings in that statistic over the past 3 months. So, we did a chart where we showed how the ETH BTC ratio is being influenced by these these industry milestones, such as the spot Bitcoin ETFs approvals. So what you need to know when you look at the ETH BTC ratio is that when the number is going higher, Ether is showing relative outperformance. And when the number is going lower, Bitcoin is showing relative outperformance. So we've studied this before. We've done a blog post where we talk about the history of the ETH BTC ratio. We've seen how it can serve as kind of like a risk-off type dynamic. So when you see more a structural sell-off in the broader crypto market, Bitcoin tends to be more of a higher quality kind of flight to safety dynamic. So it shows relative strength relative to Ether even. And then now we're seeing how it's been reacting with these spot ETF approvals. So if we jump back to earlier in the year in January, when we saw the Bitcoin spot ETFs launch, we saw how that kind of created a market structure shift to the downside, which was supportive of Bitcoin relative to ETH. And that stayed intact until last month in May, where, again, we had this surprise decision by the SEC, where I think most of the market was kind of caught off guard, not expecting to get approvals for the spot Ether ETFs, but we did. And that's kind of put in a nadir for that ratio there, and it's been trending upwards ever since. So again, it's kind of increasing awareness. It's highlighting, I think, the positive impacts of these milestones, these developments to Ether's relative value. And we also work with the CME group on making this a tradable statistic. So we have a futures contract where investors can position themselves for that. Yeah,
absolutely. I want to sort of go a little bit deeper into that, Gabe. We are trying to improve the sophistication, for want of a better word, of the heavy hitting institutionals that do pay attention to what we do as an insight into the the ever increasing coalescence of traditional finance and digital assets. And of course, the ETH Bitcoin ratio is a low-hanging fruit in that respect. So, what I would ask you, and we've kind of touched on this already, but I think maybe from the insider's point of view, but what I want to ask you from the outsider's point of view, what is the opportunity to be had in understanding the ETH Bitcoin ratio?
I think it's going to serve as a valuable tool for portfolio managers and for folks that are trying to be tactical in their ETH Bitcoin positioning going forward, because it's a much more, I think, efficient way of tactically adjusting your positioning, whether you believe one might be stand to outperform the other in a short-term sense. So if you are maybe tactically long Bitcoin versus Ether, and you see the ratio reaching new lows and starting to break up to the upside, there's a way for you to, instead of having to trim, Ether or your Bitcoin exposure, you could tactically use this ratio to position yourself for that view. So I think it's just taking these things into consideration. There's tools that institutions are now it's now becoming at their disposal that where they can take advantage of these types of maybe mispricings or inefficiencies and reflect that view in a very efficient, simple way, where you're just only doing one leg of the position versus trying to trim or long or do something that's a little bit more complicated that creates more operational risk, right? So that's where I think it's important to consider this ratio kind of in conjunction with all the other indicators, all your fundamental analysis, and have that in your toolbox at your disposal.
Yeah, absolutely. And I just wanted to mention briefly in passing to the same point. It is a Bitcoin and Ether world, and increasingly an Ether Bitcoin world in terms of the ratio. And as Gabe mentioned, we do have our CF rolling CME Bitcoin Ether basket futures index. The data is fed into it from our CME CF Bitcoin reference rate and also CME CF Ether dollar reference rate. Now, going one step further, we also now have released, I believe in the last week or so, in addition to the CME CF cryptocurrency pricing products family, whereby the CME and in partnership with the CF benchmarks have now launched Ether Bitcoin ratio indices. So we have a CME CF Ether Bitcoin reference rate, and we have a CME Ether Bitcoin real-time index. That is to go with, it doesn't necessarily, it doesn't settle any particular product, but there is a product at the moment, the Ether Bitcoin ratio futures that they basically the CME offers. There's a sort of natural fit there, both in an observational sense and potentially down the line, in a sort of like operational sense as well. So just wanted to bring that in as being part of the theme of the moment. Now, moving on, I want to say that we're going to go from the sublime to the slightly ridiculous, but maybe that's a bit unfair of me. But I do say that because we're going to talk about meme coins. It can't be avoided. If Gabe mentions it in his Quarterly Attribution Report, his high-minded Quarterly Attribution Report includes meme coins, and something clearly is going on. So can you tell me, Gabe, what has driven the surge in meme coins like Shiba, Inu, and Dogecoin, and probably others too?
Well, I can't help but make another parallel. So
go for it.
Yeah, it's very timely, right? We're seeing the meme stocks pop up on investor radars, and now we're seeing meme coins pop up on our radars. So I think for meme coins, it's been a combination of factors, and to look at the constituents that we're talking about in our indices, it's Shiba, Inu, SHIB, and Dogecoin, DOGE. So with SHIB, we've seen a rise of token burns, which is essentially, you could say it's like a share buyback, but it's a mechanism designed to reduce the circulating supply. And what that does is of course, bring us back to the Econ 101 type dynamic, where you reduce supply, you potentially create a catalyst for increasing price. And certainly the foundation there, the community has been, I think, very active. They launched this Shiba swap platform, which is a decentralized exchange that's on the Shibarium blockchain, and that's actually, we're seeing that increase the SHIB token burns, but it's expected to kind of continue that dynamic. So it's creating, I think, a deflationary effect. That's kind of the idea. That's been boosting the scarcity, and it's certainly been supportive on the price. So on the Doge side, it's a little more interesting. We were still seeing a lot of high profile individuals. In this case, Elon Musk, who's likes to engage with the community and use his platform. And that's caused, I think, some outperformance, some relative outperformance for Dogecoin. So you're seeing, I guess, in the broader sense, you're seeing a renewed interest in meme coins overall. And so what that means is, as you see maybe other categories of the crypto ecosystem start to gain more exposure or more positive price action, whatever you want to say, that can be viewed as either, are we starting to see some more exuberance, maybe perhaps, but we're also seeing some more, I think, broadening overall participation, right?
Yeah,
in different categories.
Absolutely.
So various ways to look at it.
Oh, absolutely. And that's exactly the point that I was going to make, in the sense that you cut through my devil's advocate sort of stance, as eloquently as ever, Gabe, with the fact that clearly SHIB, you sound like entirely serious developments happening on the SHIB network, or Shiba Inu network. And of course, we know that Doge has got a long track record of development. So, the counterpoint to people like me, or I'm not necessarily in that camp, but I wanted to sort of sound like I was, is that these are, serious, sort of logical, rational developments. And of course, the second sort of takeaway is that basically these bring in new participants into the crypto space by being, or perceived to be having a lower sort of threshold to enable, of interest, or to enable people to understand and to be interested because it's slightly silly or slightly fun. You saw what I'm saying? So these coins and others like them do serve a purpose. I mean, there is a silly end. There is an absolutely crazy, ridiculous, pointless, shouldn't exist end. That's right there. But the meme coin, the meme coin phenomenon is, perhaps a little bit more substantial than perhaps a lot of people have given it, given credence to date. I think that's fair. Would you not? Would you say so?
Yeah.
Yeah.
I think it's fair. And to that end, I think it's also a good time to kind of highlight the more, I guess you could say they're related, but these other protocols that stand to benefit from this, right?
Yeah.
So
yeah,
I think in this case, it's very clear, and we highlighted this in our attribution report, that there's been a clear winner from the meme coin mania, or however you want to call it, the meme coin saga. It's a great kind of riff
good.
on.
I just didn't say because I thought it's too cliche. But anyway, no, you're absolutely right. Meme coin mania is good.
Yeah, and so, and that's because if you look at where these meme coins are being launched, and we're talking now outside of SHIB and Doge, but you're seeing kind of like the ecosystem, kind of the activity across the ecosystem start to pick up, and that's where Solana, ticker SOL, has seen a lot of growth. That's driven by the popularity as it being the preferred platform for meme coins and airdrops. And that ultimately translated in SOL token being the largest contributor to our Web3 smart contracts index over the past 3 months. So
sure.
If we break down some numbers here, since March of 2024, we've seen 110% increase in TVL.
Wow.
On DEXs or decentralized exchanges. That's surpassed $1 billion for the first time. If you look at trading volumes, all right, that's risen 161%. We're seeing volumes now, closer to 16 billion, up from 6 billion. So compared to the prior quarter, so there's a surge in activity. I think that's strengthening Solana's network's effect. Certainly, it's been on a tear since the FTX lows, and it's been kind of a leader, but it continues to kind of find this renewed, second, third wins, right? As you see more active traders, as you see more catalysts, more reasons for the network to kind of gain more strength. So it's an interesting way to see how this is all playing out. I think the growth of the meme coin segment is just going to probably continue to attract more and more users, more developers in the space, and kind of help foster adoption for that ecosystem going forward. So Solana certainly has stated to benefit from all these things so far.
Excellent. And let's talk about another specific coin. Now, we may be slightly changing horses in the sense that we want to get onto DeFi, but we're in a similar sort of situation where you have a specific segment that is having a specific reaction to the stimulus that we've seen in the rebalancing period. And one standout in that respect was MakerDAO. Its resilience in the rebalancing period is something that you've actually spotlighted. Can you give us some more details on that particular aspect?
Yeah, so the DeFi space overall had a pretty challenging quarter. Just to kind of rewind and take a step back, it was I believe the second worst performer of our portfolio constituent indexes, and also experiencing very negative or very narrow breadth. So 2 of the 13 tokens finished in positive territory. So that would be MakerDAO's MKR and ETH, which finished in positive territory. The other 11 tokens declined by, on average, 26%. So yeah, jumping into MakerDAO specifically, this token really stood out because it rose by an impressive almost 25%, where the other constituents all severely lagged. I think a lot of this was attributed to this demand for MakerDAO's DAI stablecoin, which is collateralized by various cryptocurrencies, but it's pegged to the US dollar, and it's maintained that peg over its time. So this growing adoption, again, where we talk about a secular trend in the crypto markets, it's tokenized dollars, crypto dollars. That's something that our previous guest, Mike McGlone, would always highlight. He loves talking about, that there's people that talk about Bitcoin and Ether, but the biggest, growing trend has been this tokenized dollar market, right? So certainly they've stood to benefit from this. They've positioned themselves to be more serious in this space. So the governance, the DAO, voted to double their maximum debt ceiling to 2.5 billion of DAI, which I think is leading to more demand into the ecosystem, and it's kind of fueling this perpetual motion of DeFi. So I think the successful improvements that they're making, the seriousness that they're taking to kind of increase their treasury holdings, is all been very constructive for the DAO token, which is MKR, which is what we're talking about here. So it's just another, I think, narrative that you can see where there's, in spite of broader weakness, you still see some resilience in the DeFi space. And when you see some negative headlines come through, you still see some parts of it permeate positive performance.
Sure. And basically, sticking with the DeFi space, again, we're going in a really logical way on this occasion. Let's talk about Uniswap, because Uniswap has had the sort of good fortune, if you want to put it that way, to benefit from regulatory developments. Can you elaborate for us?
Yeah, I was alluding to it there at the end, but there were some negative headlines that certainly led to this category to be an underperformer for the past quarter. And that was on April 10th, we saw that the SEC issued a Wells notice to Uniswap Foundation. This is the first step of indicating a potential enforcement action. What that did is it kind of immediately drove the price of Uniswap token Uni down. It dropped by 38% by May 1st. And that is such a big piece of the total decentralized finance ecosystem that it really brought down our composite index it brought it down by 28% over the same period. So it was a very sizable impact. It's a very sizable token in the portfolio. So it makes sense that we're seeing such sizable detraction when this token falls in price. But we also saw a little bit of a retracement, and that's been healthy. So on the back of the surprising decision by the SEC to approve Ether ETFs, and remember, Ethereum, the blockchain, is a very important blockchain for these DeFi tokens, and so that surprise alone kind of helped pair some of Uniswap's losses from the Wells notice that they were issued in the previous month. On top of that, we're seeing, again, this potential for a landmark bill to be passed in the U.S. That's the FIT 21 bill.
Yeah.
It did not get signed into law. It was vetoed by the president. But I think the sheer fact that this is becoming more of a political issue this year, it's bringing this notion that we could see a legitimate framework eventually get passed.
Yes.
By
that's fair,
policymakers here in the U.S. And that's also helped Uni token and the DeFi space recover. So we saw Uniswap rebound over 25%. After these kind of positive developments, despite the fact that they had a pretty bad event occur a month before.
Yeah, and just for context, Gabe, what we've seen over the rebalancing period, and maybe not even the entire rebalancing period, in terms of the retracement of Uniswap and other tokens like it in the wake of these regulatory developments that you mentioned, it doesn't remove the fact that they did receive a Wells notice. And what you said, a Wells notice typically is the precursor of some sort of like enforcement action, not always, but quite often. So, just as like a sort of moderating effect on that positive sentiment could well be still in the pipeline.
Yeah, absolutely.
Okay. Let's continue because we've de facto moved into specific segments. Let's talk about the Digital Culture Index and the Blockchain Infrastructure Index. Now, I know that the Blockchain Infrastructure Index underperformed markedly. How can you contextualize that in what we're seeing, more broadly, particularly in light of against the backdrop of the the broad cap indices, and maybe if you like the DeFi, and also the that's all of them. The large cap. Yeah. How can you
Yeah.
characterize it, Gabe?
Well, one visual that's probably going to help a lot is if we were to show the absolute performance of the blockchain infrastructure constituents, which was very, I would say, broadly negative, and the majority of them, 67% of the constituents, all underperformed the headline index. So it was a very, very challenging time for blockchain infrastructure. I think when you look at the Wells notice that was issued for Uniswap in April, that had a lot of impact on the layer 2 scaling solutions that are in this index, this portfolio index. So you saw tokens like Optimism, like Arbitron, being some of the worst performers, right? Also, there were some silver linings in infrastructure. I think Render's RNDR was the only positive performer in the past quarter in the infrastructure index. That was because, again, we're seeing the AI narrative kind of permeate through. So that token price moved quite a bit higher after the founder spoke at NVIDIA's GTC 2024 AI conference, talking about how Render protocol could be used as kind of like a decentralized AI platform. So I think the overall, the secular catalysts, the bullish narratives of improving scalability, efficiency in the infrastructure space are still intact. It's just whenever you get these headlines of Wells notices, of negative regulatory surprises, it's certainly creating, I would say, some bumps in the road to that. On the culture side, it's really been driven by, I think, a lot of the meme coin story. So, it's SHIB has been a key contributor. Ether is also a big contributor because it's such a higher weight compared to the rest. So that's helped kind of bolster the headline index. And that's kind of what we're seeing there. Also, the VR and AR segment is kind of starting to see some pullbacks. So you had Sandbox, that token declined by 34%. You saw Decentraland, the play to earn protocol, and its native token Mana pulled back over 32%. So all of these tokens combined created a drag in that segment, and that's kind of created this kind of overall negative picture for those two headline indices.
Okay, so I'm going to give people a long phrase for the next question, and it concerns obviously Chainlink and cross-chain interoperability protocol.
That's hard to say.
Apparently, well, not just apparently, we know that this has been big news and has enabled Link, which is the Chainlink, the sort of like token associated with Chainlink, to basically stand out in the period. Can you explain the significance of Chainlink's cross-chain interoperability protocol and the recent surge in usage that it seems to have coincided with? I don't want to say cause, but it could well have. Yeah.
Well, yeah, it's certainly challenging to say. And so, cross-chain interoperable protocol. I'm thankful there's
an abbreviation, CCIP.
There's an abbreviation, CCIP, right? Yeah. So what this does is it's basically enabling a secure and seamless way for these different networks to communicate and for transactions to basically jump over to these different blockchain networks, right? So some of these benefits and key features is that you can basically enable the transfer of assets and data, and you can share that across chain vis-a-vis decentralized apps or dApps. So what that does is it just kind of allows these bridges, right? It connects these different blockchains up, and now you're seeing this ecosystem that is now connected to this ecosystem over there, and it's all done in a very efficient, secure way is the idea here. So it's broadening a lot of the capabilities of decentralized apps. It's enabling them to leverage all additional information, additional data. Oracles can communicate with each other and across multiple chains simultaneously. And so it's creating, I think, a more versatile blockchain ecosystem overall. So for Chainlink in particular, it stood out as a you could say it stood out as like a defensive performer in the sense that it didn't decline, as it posted positive gains, but it's because you're seeing, I think, a lot of activity on the CCIP. A lot of usage has been coming in. So you're seeing a lot of stablecoin transfer volumes coming through the protocol that exceeded over 100 million in April. And we have a good chart that shows kind of how this activity's grown. So it's generated a lot of fees for Chainlink in that quarter. We saw that it did, I think, $460,000 in transaction fees during the past 3 months. So that's pretty significant. And it's increasing a lot of activity on Ethereum layer 2s overall. So it's something to definitely keep in the back of your mind going forward, seeing how that type of interoperability will foster a more dynamic blockchain ecosystem ahead.
And you mentioned, just real quick, Gabe, you mentioned that Link did actually seem to behave, maybe display some defensive characteristics in the period for the very reasons which you pointed out, but it wasn't immune, of course, being part of the blockchain infrastructure and being within that sort of like, just very, very imprecise term, within that niche, it was also prone to the same regulatory currents that both Uni was sort of like prone to most directly, because obviously it was, it received a Wells notice itself. But of course, Link potentially being in a similar position is obviously coming into people's minds, not in the same position, but people can envisage it being in a similar position. So that's a negative. And of course, the positive as well, it did benefit from those surprise ETF approvals. Just trying to frame it within the same context, right?
Yeah, it's a push and pull. I have to correct myself. I think I might have said that Link had a positive return over the past few months. It actually did outperform.
Yes, I think I did.
The index.
I thought that, yeah, but
it still posted a negative. Looks like almost a 13% drop. So I stand corrected. But yeah, you're seeing kind of that push pull dynamic. Exactly. That's kind of what we use to summarize this overall quarter as being kind of more mixed.
Yeah.
So yeah,
and you've summarized it as we come to the end of our major headlines. Is there are there any other sort of nuggets as takeaways that you would suggest investors and observers and acolytes have in their minds as the main takeaway from this QAR period?
That's a good question. I think it's going to be interesting to see as we go into the summer months, the narrative shifts towards the digital asset space kind of continue. We've all been in this world here for a few years, and coming from a traditional finance background, we've seen how we've gone through a lot of turmoil, a lot of negative, headlines, and we were seeing that reverse and some of the stigmas being washed away. So certainly Bitcoin's become, I think, such a legitimate store of value that even the traditional finance players can no longer deny it. So when we think about the next phase in crypto, we're gonna see further applications of Bitcoin in portfolios as a strategic holding for store of value. And two, we're gonna see now with Ethereum becoming more of a generally accepted strategic asset for the decentralized economy. We're going to start to see, I think, more just developer activity in that area too on decentralized apps. This idea of having, blockchains facilitate transactions and create, usable protocols and applications for day-to-day citizens, for society overall, is going to be interesting to see. And I think we're starting to get to the point to where that's going to start to really pick up. So we're going to be putting out more research on that, and so stay tuned. But it's just been very interesting to see even large institutions start to tokenize traditional asset classes. So That's something that we talked about, and I think on our 2023 outlook, so a few years back, that tokenization trend, and it's really starting to happen now. And I think it's going to be interesting to see the next stages of where that all goes.
Absolutely. Major currents, of which that is just one. And of course, the regulatory side, the positive and negative, of which there are quite a few coming up. And those are going to be in your next QAR report. So there you have it. Our March to June quarterly attribution report, produced by our research team, overseen by our head of research, Gabe Selby. And if you'd like to read it in a bit more detail, obviously to absorb it in a bit more detail, you can go to cfbenchmarks.com, navigate to the News and Insights tab, and scroll down and find Research and Insights, and the CF Benchmarks Quarterly Attribution Reports June 2024 edition will be the first item in the menu. Beyond that, cfbenchmarks.com, of course, is the place to go for all our other content. And if you have enjoyed listening to this podcast and you'd like to hear more of our episodes, of course, you can find all of them on Spotify, Apple Podcasts, Amazon Podcasts, Google Podcasts, and others. We will see you again for another episode of CFB Talks Digital Assets. Thanks for joining us.